Hi, today we are going to discuss about company accounts. The company form of organization is one of the most scientific form of organization. It's a most scientific form of business organization that enables business to carry on wealth creation through optimum utilization of resources, which is the main aim of any business, that to utilize the resource optimally and create wealth. And that is possible in a large scale in a company form of organization. In simple term, company is an association of person formed for a common purpose or object. There has to be a common business purpose. It could be for profit, it could be not for profit, but there has to be a common purpose to form a company. The law defines company as a company formed and registered under Companies Act 2013 or any previous act. Previous act means the act which was established before incorporation of this Companies Act 2013. On that, if some companies are registered and incorporated, those companies are also will be treated as a valid company. There are some of the previous acts which are on which, if the organization is built up, which is considered as company, or Companies Act 1882, Indian Companies Act 1913, Companies Act 1956, and any law governing companies in Jammu and Kashmir before commencement of the Central Law Act 1968 and the Portuguese Commercial Code. Under any of this law, if a company was incorporated earlier, it will also be treated as a valid company. Now, if we understand the term company, there must be a group of persons who voluntarily agrees to form a company under the law. And once so formed, it becomes a separate legal entity having perpetual succession with distinct name of its own and common seal. That means there has to be a group of people to start the company who should voluntarily agree to form a company, not by force of somebody. So it should be voluntarily. And once this company is formed, it becomes a separate legal entity. It will have its own identity. It will have its own name, and the company will have a common seal. Let us understand the salient features of the company. A company is an incorporated association. It comes into existence only after registration under the Companies Act and being created by law. It is regarded as an artificial legal person. It's not like a human being, but it has a lot of rights and obligations which similar to a person. But it is created by law. That's why it's an artificial legal person. It has a separate legal entity. It is different from its members who form it, and it's not affected by the change of its membership. The members can die, members can leave the organization, but the company does not dissolve just because members are leaving. There will be new member can come. The company by itself can enter a contract. It can sue. It can be sued by somebody because it's a separate legal entity. The company will have a perpetual existence. The word perpetual meaning continued. The company is going to continue. The members may come and go, but the company will continue. It's created by law and it can owned up only by law. The death, insolvency, change of members, all these things does not affect the existence of the company. Company will have a common seal. Companies Act 2013 requires common seal to be affixed on certain documents such as bill of exchange, sale certificate, etc. Now the use of common seal has been made optional. Now all such documents which requires affixing common seal can either be signed by two directors or one director and company secretary of the company. The common seal will look like this. A company has a limited liability. That means in the company form of organization, the liability of the members are limited. No member is liable to pay more than the nominal value of the shares. In case of fully paid up shares, there is no other liability. If the shares are not fully paid up, if some monies are not called yet, the liability will be restricted to the extent of unpaid capital. There has been a distinction between the ownership and the management. Shareholders are the real owners of a company. but they may not possess all the skill sets that requires to run the company. Because of that, shareholders appoint board of directors who manage the running of the company on behalf of the shareholders. The This process of appointing the board of directors is actually resulting in separating the ownership from the management. The company is not a citizen. It does not regarded as a citizen in the same sense as a natural person, even though it's a person created by law. It does not enjoy the citizenship rights and duties like a natural person. Shares of a company are easily transferable by members. The listed company people do trade in the stock exchange and it easily get transferred from one person to another. But there are certain exceptions. There are certain restrictions in case of a private company to transfer the shares. The law requires to keep a prescribed set of books of accounts, and failure to maintain those books of accounts attracts penalties. The company is usually with large number of members. It is expected that the books of accounts are maintained properly. So law has defined certain set of books to be maintained and the company has to follow that. There has to be a periodic audit. The company accounts have to be periodically audited by a chartered accountant who are appointed by the shareholders of the company. The right of access to the information. This is one fundamental right of a shareholder. Shareholders are the true owner of the company. So they have the right to seek information from the directors by participating in the meeting of the company. Individually, they cannot just ask the information. They should participate in the meeting of the general meeting or extraordinary general meeting. They participate in the meeting and then call for the information which directors are supposed to provide in that meeting. Now that we have understood the overview of the company, in the next session, we will be discussing about various types of the companies. Thank you.